Hi everyone, and welcome to another episode of Market Bites. Today we are going to discuss the latest retail investor beat, and I'm joined here today with our US analyst Brett Kenwell. So, Brett, how are you doing today?
I am doing very good, Neza. How are you doing?
I'm doing well, thank you. Actually, I miss Sam a bit because normally he's leading all of these things, so I'm a bit nervous, but I think that we will make it through.
Yeah, I miss Sam too. He's very good at making all this interconnected and flowing very smoothly. So we'll give it our best. We'll see how it goes.
Exactly. So yeah, today we will talk about a retail investor bit. We do that every quarter, and basically it's just a large global survey that eToro does it every quarter, and it gathers insights from like 11,000 investors across 13 different countries. So it's really we could even say like it's a global survey. So we get into heads of retail investors on how they think about markets, risk, opportunities, all of that. And I think it's very important for us to give us some indication how they are thinking and how they're going to position their portfolios for further year or at least a quarter ahead. So I think that maybe we could start with overall mood of retail investors, because markets have had a quite volatile year. We saw that inflation moved lower, central banks kind of shifted direction, and yet sentiment this year was surprisingly positive. So how strong is retail investor optimism as we are heading into a new year?
Yeah, going through the data, I would say that the takeaway is fairly confident. 56% of respondents said they expect the bull market to continue into 2026. That number was actually a little bit higher in the US. It was up at 63%. But regardless, it's a majority of investors, no matter how you want to cut up the data, feel pretty good going into next year. And I think it's worth pointing out that this survey was done basically in the first half of November, which, we were in the middle of a government, what ended up being a record-long government shutdown in the U.S.
Yeah.
There was a market pullback, some volatility. So, there's concerns going on at that time, and they remained fairly confident. I think the other talking point as it relates to the mood or the sentiment with retail, 78% of the respondents said that they felt confident about their portfolios. That's really kind of saying a lot after we went through what ended up being a profitable year, but one filled with a lot of volatility, particularly in the beginning of the year. And as we still face some risks and some, headline concerns going into next year. So I think it's very promising for retail to feel that way. I think kind of speaks to their, as they gain experience, they're also gaining confidence. And, I think we're seeing that in the data.
Yeah, I couldn't agree more with the confidence. I think that retail investors are gaining the knowledge, and also our global equities analyst, Lale, highlighted that retail investors are kind of starting to look past these short-term fears, and they're focusing more on the long-term potential. So they are realizing that achieving goals is taking some time and consistency, that not everything can be achieved just overnight. So in my opinion, it's kind of a mindset shift, that rather to react on all volatility in the market and emotional headlines, the retail investors are kind of going into direction that will give them long-term growth, and they're sticking to those decisions. So their mood is not changing so fast. They keep positive on the long term, but of course, yeah, they're not anything comes without risks, because even the most optimistic investors are very clear that what could derail this momentum of everything what's happening on the market. So of course, there are risks that we already saw this year, and one of them was political as well. But what are those risks that retail investors are definitely focusing on as we are going into 2026?
Yeah, any part of being a big part of being a good investor is being objective, right? So realizing the positives and the things that can go right, but also being, open-minded to the things that can go wrong or the risks that can pop up. And unfortunately, the risk that usually ends up taking markets down the most is the one that kind of comes out of the blue. You don't know what it's going to be, you don't expect it. But I thought it was really interesting actually to go through the risks that retail investors are looking for next year, because to your point, politics were a big concern. They were the top concern, actually. Political concerns were 43% of respondents cited that as their largest risk, but not far behind, 40% was geopolitical risk. So I think, that says a lot about where we are in today's world, in our environment right now, because, Neja, go back a year and a half, 2 years ago, that top concern was going to be inflation and, recession worries. And we've seen those. Those are still concerns, no doubt. I think number 3 was economic concerns. It was like roughly a third of respondents cited that as their top concern. But the fact that politics and geopolitics sit at the top, I think that really says a lot about where we are today, no?
Yeah. I couldn't agree more. We saw what happened in April when those big political headlines moved the market, and we saw how those changes about tariffs also influenced where the market direction, not only just for a day, but for a midterm direction, we could even say. And all of those came out of blue. What's going to happen, no one knew on the market, and no analyst could predict the direction of political decisions. So this is the uncertainty that investors have to deal with. And I think that as we are heading into 2026, this kind of risk will stay. But as I said, retail investors are learning, and with that, they know that on the long term, those kind of moves don't necessarily affect their long-term investments. But we also still have inflation, supply chain risks, and also earnings. Those are big factors that kind of impact investors and market overall. But how relevant are they for the retail investor?
Yeah, they're not as relevant as the political and geopolitical concerns, but the irony of all of it is that a lot of these things are interconnected. As we were kind of mentioning, when political tensions flare, something specific, it's definitely something like tariffs. That has a trickle-down effect from everything to earnings, supply chains, even just really like sentiment and worries about inflation. And some of the numbers here, I can see them behind my screen. 27% of investors fear that inflation could persist or reaccelerate, challenging central banks and squeezing consumer spending. 23% were worried about supply chain disruptions or commodity shocks, and 16% were worried about corporate earnings as a potential drag. So, I think it's especially relevant now with the Fed having just lowered interest rates. But that's sort of the way that these financial talking point, but how that affects borrowing costs and consumer spending power. All these things are intricately interconnected, and that's why when there's volatility in those decisions, like as you mentioned with tariffs, it's very hard to get the forecast right, and it's very hard to really figure out what the end implications are going to be, because things are so interconnected and there's a lot of moving parts. When they move fast, they're very hard to predict, how they're going to shake out. But I guess just on that interest rate note, Neja, I think we also asked about how retail investors were looking at interest rates for 2026. What were some of the insights we saw with that?
The survey was done before the cut we had yesterday, but expectations back then were kind of divided, because the largest share, like 37% of everyone in the survey, they expect rates to decline further next year. But meanwhile, almost 30% of all participants are anticipating increases. So this is showing that kind of uncertainty that is still lying around, and inflation, and also about central policy paths, because among those that are expecting decreases, most of them only expect slight to moderate cuts, typically between 0.25 to 0.75%. And investors kind of seem to believe the central banks will move cautiously and not that fast, and they will try to avoid those extreme swings, which kind of reflect more measured macro outlook heading into 2026. And of course, here it is also connected with political risk, as we know that Federal Reserve chair will change in next year, so all of those things can impact further interest rate decisions. As we see all of the risks that are approaching, and retail investors kind of know what they can expect if they face those risks. They are positioning their portfolios according to them. So, how do retail investors adjust their portfolios as interest rates decline? Are they more bullish because of that or not? What's happening around that?
Yeah, I think, it's important to note too, this being a global survey, there is going to be a lot of different responses depending on, if someone's looking at the ECB or the Fed or, the various central banks all over the world. So that is going to have an impact. But even in the US, we saw even the Fed seems to be, kind of a clear trend lower to rates. Maybe there's questions of the frequency of rate cuts, but even in the U.S., we saw that uncertainty in the responses. Only about half of respondents expected lower rates in the one or two, but there was quite a bit of uncertainty about whether we'd get any rate cuts, and there was a few. There was a notable group of respondents who actually did say they thought rates could go higher next year. So that's obviously against the consensus, but I think to your point speaks to the uncertainty that we've seen around interest rates as we go through 2025 and now into 2026. But in terms of what they're doing, about half of the global respondents said that they had already adjusted their portfolios for interest rates. Of those who are anticipating further changes next year, about a quarter of them plan to invest more. That charge being led by the younger investors, the Gen Zs, the millennials, and they're looking to more, they're really looking pretty diverse, but into growth assets. They're looking to commodities like gold. They're looking at crypto. Even some investors still staying focused on cash as rates remain, fairly elevated compared to, COVID and the years before. So, but the generational stuff's very interesting. Was there anything that kind of stuck out to you on that demographic?
For me, it's always interesting to see how different generations are investing. But of course, it kind of makes sense because younger investors, they have longer time horizons, they have more flexibility and generally more risk tolerance. And I would even say that normally they're more interested for more risk-averse assets like cryptocurrencies, anything like that. So for younger investors, falling rates mean more potential for higher growth and lower borrowing costs and also better opportunities to compound returns. And besides that, they're also early in their investing journey. They are still, if they make investing mistakes, they still have time to grow from there. They don't have time issue, so they're still aggressively building portfolios. On the other hand, we can clearly see how older generations are thinking differently because they are closer to retirement. They need more security and they prioritize capital preservation, and that naturally makes them more cautious about adding new risks to their portfolios, and they're not that risk averse. But also, based on everything that we talked about, it's also a good question to ask which asset classes are investors planning to increase exposure in the next year.
Yeah, kind of going back to the broad picture, we see a focus on growth stocks, growth assets. In the U.S., there tends to be a big tendency for financial stocks to be popular among investors. That I remember when we started doing these surveys a couple of years ago, that always surprised me, how much investors like financial. I always expected tech to be so far and beyond the favorite, but the financials actually really hold their own quarter to quarter. It's not an anomaly. But outside of stocks, there's that interest, that appetite remains there for crypto. Dividend yielding stocks also ranked fairly high, which is not surprising with interest rates moving lower. Investors looking to kind of capitalize on something that has maybe a more attractive yield for their portfolios. But still, cash and short-term investments that remain fairly attractive for investors. I think even with rates moving lower, and they have been moving really lower since the peak in 2024, there still is that need to have some money in the sidelines, some cash in the bank, whether it's for life events, whether it's just to have some dry powder in case we get something like the tariff sell-off we had earlier this year. People want to have a little money, sitting back in the coffer so they can take advantage of it. But on that note, was there any, zooming back from the assets and the what they want to buy question, is there any sort of bigger themes that stuck out to you just on the whole?
For me, if I take a look at this survey as a whole, I would say that it kind of gave us a mix of optimism and also realism, how investors are thinking, because I would say that they still believe that this bull run has still some room to run and they feel confident in their portfolios, but at the same time, they are also aware of all kinds of risks that are facing their portfolios, and they are ready to change their narrative fast depending on what kind of risks they're facing. And at the same time, interest rates are pushing investors, especially those younger ones, as we were talking about, to reposition for long-term growth. And I would say that this is kind of a moment that is defined by strong underlying conviction, but also paired with careful risk awareness. And I think that this is the main theme as we go to New Year. But everything can change depending on the risk they're facing, and also on further central bank policies. So that's it for our retail investor beat. We will see what retail investors are thinking in the next quarter. Thank you, Brett, for joining, and see you guys next week.